we're talking about a loss and how to get the most benefit out of that. A lot of times we talk to clients and they think, hey, I've had a loss from my business or from a piece of real estate, and I should be able to just deduct the entire thing. It's going to help me. It's going to offset my W-2. It's going to offset, maybe you've got other income from investments, and they don't realize that there are certain limitations that can make some of those losses not deductible in the current year. So we're going to kind of go through, I call these the 5 different gates. If, for instance, you get limited at gate 1, you don't even get to look at gate 2, 3, 4, or 5 to see if they apply, because all potentially could be limited at gate 1, for instance. You've got to look at each of these in progression. You've got to look at all 5 and make sure, okay, can we get through, or are we going to be able to really fully realize the benefit of this loss, and how are we going to realize that? Is there any planning that we need to do to make sure that we're taking advantage of that? And let's get into it. The first one is basis. And so essentially what basis says is that you can't deduct what you don't have invested. It is something that the IRS has put in place because they really don't want people to generate a tax loss but not really have any skin in the game, right? It's one of those that, again, I think doesn't get a lot of attention until it comes time to actually file a tax return. I've seen a lot of situations where clients have either been in an income position but taken a lot of distributions out of the company, or been in a loss position and maybe also taken distributions out of the company, and come to a spot of like, oh, well, what do you mean I can't deduct this loss? Or what do you mean I have to pay taxes on those distributions? Because that can happen too when you don't have basis. There's 2 ways that I describe it. One is, think about if you invest in a stock like Apple. Your basis is going to be what you paid for that stock. And so you buy a share of Apple for $100, your basis in that share is $100. With a partnership or an S corporation, it works in a similar fashion, but besides the money that you contribute, there are things that it will either add to your basis or subtract from your basis. And so that's what you see on the right-hand side of the screen. Is you start out and your beginning basis is either the ending basis from the last year, or if you've got a new business, it starts at 0, right? You get a plus for any contributions that you make, and that's whether it's cash or property. You add to your basis for any income that you pay tax on. So again, with these flow-through entities, if I have an S corporation and that entity generates $100,000 of profit, I am paying tax on that $100,000. So that $100,000 increases my basis in the stock of that S corporation. For partnerships specifically, any share of debt that you have as the owner gives you an increase in your basis. That is not the case with S corporations. And so we'll look at an example of where that makes a little bit of difference. And then finally, any distributions that you take reduces your basis. For instance, if your basis was 0, I put $10,000 in, and now I take $5,000 out. Those distributions will reduce your basis before any losses do. And so we've seen situations like that where maybe my basis was $100,000, and because I've paid taxes on income in the past, but now I took $100,000 out of the company in a distribution, and then the company lost money. Well, that distribution applies first, so my basis goes from 100 down to 0. And now if I have a loss, I'm not going to be able to deduct that without some planning involved and being able to do something that's going to increase my basis. So this is the first gate. And again, the big difference to consider when we're talking about a partnership and an S corporation is when it comes to debt. Partnerships, the share of it, the debt of the partnership gives the partners an increase in their basis. So again, if you think about, I've got a 50-50 partnership and the partnership has $100,000 of bank debt. If that's allocated between me and my partner, 50-50, 50,000 to him, 50,000 to me, that 50,000 will give each of us an increase in our partner basis. That is not the case with S corporations. The only time that a loan will give you an increase in basis for an S corporation is when it is a direct loan from you to the company. And truthfully, my recommendation on that is if you're putting money in the company and it's not structured as a loan, meaning I've got documentation, there's appropriate interest charged, there's expectations of repayment. A lot of times it's more efficient to just classify that as a capital contribution. You get the same increase in basis whether it's a contribution or a loan, and there's less tracking related to the capital contribution. So again, if you're in a situation where you may have basis limitations, what are some things that you can look at? Again, putting money in, that capital contribution will give you an increase in basis. If you do need to go the route of a loan and want to loan the money to the corporation, you certainly can do that. But again, you want to make sure that it's a true bona fide debt. You've got a debt document and instrument in place, and that you're truly got interest and all that, and it's truly treated as a loan. And again, I'll highlight that just a guarantee of entity debt for an S corporation does not give you an increase in basis. One other thing to mention, if you are in a situation where you get limited, so hey, I've got a loss that I cannot deduct this year because of a basis limitation, what happens then? Those losses will carry forward and they never die. The only way that they would potentially die would be if the company shuts down and you don't have basis, and then those losses, just essentially don't get used. And so that's a situation where, again, it takes some planning. So if you're in a situation where potentially you're looking at shutting down a business or something like that, you want to make sure that you get the full benefit of all of those losses. So there's definitely some planning to be had there. But again, to the extent that the business continues on, those suspended losses will continue to carry forward.